G'day and welcome back to the next video. This one is titled what to do with the sale proceeds. I'll jump straight in. Obviously this will be a bit more of a lengthy video, but there's a fair bit to get through and there's a lot to know, and I won't be able to impart all the information and knowledge that I've got in a small video. Here is our general advice disclaimer, which has been at the start of all our videos, and obviously this is not personal financial advice where I take someone's individual needs and objectives into account. So when selling the farm, often find that selling the farm itself is not the scariest part of the process, but it's really what happens with the money after the farm is sold, and knowing that you only get one shot at selling the farm, make sure you get it right is very important. And investing for most people is a very foreign thing to do. It's something that while there are investors out there that do it every day of their lives, professionally and personally, that's me, but for most people it's not something that they're doing. So, and investing, even for the most experienced, is a complex beast, and we're always learning. It's one of those things that I will be a student of the investing game for the rest of my life. So I'm a firm believer in the way that I've ran my advice business is that building up a understanding and getting advice will help build the knowledge, and that will help people make informed decisions. That is so important. You don't need to know it all, the depths that someone like myself would know, but understanding why and increasing your knowledge will make you feel more comfortable with any decisions that you make, and they'll be informed decisions. You'll say, Rob, I understand why we're doing that. I know why we're going down that path. We know why this business is good because of what you've explained to me. So you only get one shot at it, so let's get it right. Now, obviously, investing, it's the returns that we get is all about the way we're invested, or asset allocation. So asset allocation is really about the amount of money that we apply to what particular assets. And that can be Australian shares, it can be international shares, it can be property, which can be listed property like Westfield Property Trust, which is now merged into a larger conglomerate with a French business. It can be office buildings that are listed on the stock exchange. It can be commercial property that's unlisted. It can be residential property. And it can be cash and conservative assets like cash, fixed interest, hybrid, government bonds and the like. So your investment returns are really dictated by how you choose to invest. The more conservative that you are, so thinking of cash and term deposits, the lower the rate of return you're going to get, and therefore the lower the performance. We're going to have low rates for a very long time ahead of us. The more money that we invest into the share market, so think businesses like Microsoft or CSL or Google, very high quality businesses. Don't just think share market, think about the share market as a grouping of businesses. Over the long term will provide very much a higher rate of return and very superior to that of cash or term deposits. But when we invest into the share market or growth assets like businesses that are listed on the stock exchange, we need to accept that we're going to get short-term volatility. Now, at the time of recording this, it's the 5th of June 2020. We're still in the midst of the the coronavirus and the share market crash. It has rebounded somewhat since its lows, but volatility is the short-term volatile nature of the share market is ever present. So to get a higher rate of return over the long term, we need to accept short-term volatility. And therefore it's really important for us, and this the second last bullet point, obviously to accept short-term volatility, we have to understand our investment time frame. And so for a lot of people thinking, right, I'm about to turn 65, I'm about to retire, I need to become conservative in the way we invest, is really quite wrong in my view. Someone at age 65, say a couple at age 65, all going well, one of those couple will make it well into their 90s, which makes them a 30-year investor from retirement. So to invest very conservatively from here, in my view, is a huge risk, because we don't allow our money to grow. The cost of living is going to have a substantial impact on the value of our money and what our beneficiaries will get down the track, or how long our money may last in the short term. So understanding our obviously our investment time frame is absolutely vital. Now this just gives you, this is work that Tim Farrelly done. This obviously changes all the time, but it gives you a look at all the different asset classes that we've got. We mentioned property, which can be seen here in the Australian A-REITs. That's the listed property investment. Emerging markets, developed markets like the US and UK, the Australian share market, all the way down to conservative cash here. Now you'll see here that there's a pre-tax rate of return. I'd say from when this is done, this return of 1.9% in cash has come down quite a bit. The Aussie equities, it's estimated that it will return around 6.5% for the coming 10 years. These are sort of 10-year forecasts. Given that we've just been through a share market crash, the share market is lower, then this 6.5% obviously will be higher than what it was when I've taken a snapshot of where the market, of this graph, when the market was at the time. But you can see for businesses here, businesses overseas are going to give us a far superior rate of return. But in doing so, you can see here that the frequency, this bottom bit here, the frequency of years when you get a negative return for cash is never, won't happen, won't go down. So these are the worst short-term scenarios that for the Australian share market, 1 in every 20 years you'd expect to say go down by 38%. Now that seems like a huge number, but that just happened 2 months ago. The Aussie market was down 37% during the coronavirus-inspired share market crash. But the frequency of negative returns is 1 every 3 years. And that's just the volatile nature of the share markets. Whilst some people say that's risky, it's not risky, it's just the normal part and ebbs and flows of share markets. The share markets are, essentially people buying and selling on these markets, and you get the emotions of greed and fear that give us these huge variations of where markets become overvalued and become undervalued. But over the long term, they return 10 to 11% per year. But to get that higher return than what you would get here on the right-hand side of the screen, where it's conservative, a very low rate of return, you have to accept the volatility. And generally we split our clients' monies up into different areas. So a more conservative client, you'll have a higher weighting towards conservative, and which is say portfolio 1, and portfolio 5 will have a much higher weighting towards businesses and growth assets. And of course our expected return is substantially different. So you can see here 6.7% for the growth portfolio number 5, and the very conservative portfolio number 1 is 3.2. And of course we'll expect much larger variations in terms of when volatility when it goes up and or down. You can see here that the portfolio 5 can drop by 30% once every 20 years, where the conservative fund only dropped by 7%. Now, of course, by being too conservative over a long term is a huge risk in itself, and I think it's really important to understand that point. Again, this is only a brush over around some of the things we do for our clients and how we try to educate them. This is work from a chap called Peter Thornhill. I've got some details of Peter's information in the last slide in this session, and it's really looking at the yields from different investments. So you can see here that we've got 2 different asset classes, both within the Australian Stock Exchange. So the yellow line here is the all industrial. So that's the Australian share market, excluding all of the resources like Fortescue Metals, BHP or Rio Tinto. And that's providing a lower rate of return. And the line above, the pink, is Australian listed property, and it's giving you a higher return. Now in recent years it's converged, so it's not terribly a big difference between both of them, but what it's highlighting is that people can go chasing yield, and you may have heard of the yield trap, where you go, gee, Telstra's got a fantastic yield of 6-7% with franking credits, which increases it even further. But the fact that the share price has halved in value in recent times, the yield doesn't show the risk of the investment or the lack of reinvestment back into that business. So when we shouldn't just focus on one element when investing, and what this is teaching us is don't just focus on yield. There's far much more to know than just yield. It's a blunt tool when assessing investment. It's part of it. We need income to live. That pays for the bread, milk and the butter on the kitchen table. But if we look over the long term, that $100,000 invested into the listed property trust, which is this line here, gets to about $350,000 or thereabouts and brings in about $10,000-$12,000 worth of income, compared to investing into the All Industrials Index, which is CSL, Magellan, the 4 banks, and Telstra. Not that I'm a fan of Telstra, but you can see the difference over a very long time, from 79 through to 2017, with $100,000 invested all the way back then. You can see, and no dividend reinvestment, you're receiving the income. You can see that you would have nearly $2 million and an income of over $80,000 compared to an income of $10,000. The same can be said for term deposits. We know the rate from term deposits, so I won't labour on this one. This one's got a couple more years worth of data, but you can see here that the value is over $2 million, and again you're still getting over $80,000 worth of income, where that same $100,000 invested into a term deposit, whilst initially back in the 80s you were getting a superior income, the yield was higher. But with the term deposit or property, generally there is no reinvestment back into the business, and that reinvestment back into the business to further build that business is what generates the growing revenues, the growing profitability to pay higher dividends and income out to shareholders. And this just gives you a look at the difference, why I prefer, based on Peter Thornhill's information, the All Industrials Index. So this is with all income or dividends reinvested. So the same figure, 100 grand invested in 79 through to 2017. The All Industrials is $12 million. The resources sector, which is very capital intense, to build mines takes a lot of money to do it, is the same money in, same reinvestment, less than $3 million. And here the green line is the All Ordinaries that they quote on the ABC News each night. Is the average between the two. I know where I'd like to be. And this graph here, and I did warn you it was going to be a longer video, and it has definitely turned into that, but it shows the risk of being too conservative. So this was some important research done recently, that you can see that if you need $43,000 to live each year, which will give you a comfortable living based on research done by the ASFA, 43 will give you a comfortable rate of return with 2% inflation, that you would need over $1.6 million in cash at 1.5% to give you 35 years in retirement. But to provide that same return, if you invested in, they've called equities, this is the share market, think businesses, that if you would need nearly 700,000 invested into equities at a 10% return to give you the same outcome. And that's even with dropping by a full 20% in year one. So that would be a disaster in someone's mind. Oh geez, I've just sold the farm, I've invested money in the share market's just dropped 20% on me. What a disaster. But because you've got time on your side, it has actually given you the same result. The money's ran out 35 years later, but you've needed nearly $1 million less capital at the start, and even with a poor start at that. This is something I show clients all the time. This is the balance sheet of Google. Obviously we know Google is the search engine. They own Android, which is on all non-Apple phones. They own YouTube, and they also have the Waymo business, which is the fully autonomous self-driving cars. So I've brought this graph up to give you a look at their balance sheet. So they have $4 billion worth of debt. Now this is probably about a year old, so they're up to about $120 billion in cash investments. So if we net off the debt, they've got around $115 billion of cash in short-term investments that they constantly reinvest back into their business to make it, to grow it and grow the profitability. So that is a strong balance sheet. The chances of anything happening there in terms of the business going broke is next to nil. Google is a monopoly business. In search, they have around 95% of all internet search, so a fantastic business. Now, I've also included the revenue from Microsoft. Microsoft is a fantastic business, and you can see here the revenue from 18 to 19 grew by $15.5 billion in 1 year. And we are just constantly using their software. Again, like Google, it's a monopoly type of business. Most of the products they use are used by business all over the world. It is an amazing business. And their revenue, which a lot is reoccurring, just keeps coming in each and every year, and it's getting stronger. This is a business that's called Ripe, based in Sydney, and they sell subscriptions to Microsoft Office 365. And they're also selling Azure, which is cloud storage. So you can see here that the growth year on year in the revenue from cloud storage is 170%. I just can't get that sort of increase in revenue in my business because we're not scalable like software is. This is Office 365. This is the amount of seats or licenses they sell, and you can see it's jumping very quickly. These are great percentage returns, and of course that has a huge impact on profitability, and they're doing it all over the world. We also get, again, this is from Tim Farrelly, some of the work he did prior. We are believers that markets go in cycles. They become expensive, and then they become cheap. We've seen that just recently. And what we're trying to achieve here is to understand when a market becomes overpriced, we want to reduce our exposure. When it becomes cheap, we want to be buying in. And that's what we've done in the very short term with the coronavirus-inspired share market crash. We were very busy and we were buying really high-quality businesses at cheap prices. So we get research on that. We pay for people that are smarter than me in that space to help guide us and help guide our advice to clients. Now, obviously, I've covered off in less than 20 minutes quite a bit, but just a small snippet of what we do here. And what I've recommended, and we'll provide the links below this video, that there's an online course on our website, and this is essentially Peter Thornhill over 6 or 7 or 8 videos about understanding the right asset class to be in. In my view, this is the gold standard. Peter is my unofficial mentor. He doesn't know that he's my mentor, but he is. There is a book as well, which I'd recommend getting, but please watch this. This is absolutely vital. After you've all watched it, send it to your children, send it on to whoever. It is really important. There's also one of my video series there, and it really goes through some of the issues that I've had with my industry, wealth management and financial planning. So there's deficiencies in my industry that I believe that I've tackled over time, and so really what I cover off on that is why I like to invest directly rather than in products and managed funds. If there's enough money, a self-managed superannuation fund is appropriate. If it's non-superannuation, it doesn't have to be AMP, MLC, Colonial First State. We can invest directly in our clients' names or chosen entity. But that video series really goes through some of the issues that I've encountered over 22 years plus in the industry, and how I suppose I invest for myself and how I invest for my clients. So please enjoy that. Apologies for the long video, but this one was always had to be. Thanks for your time, and we'll speak to you soon, and we'll see you at the next video. Thank you.